In this video, I'm going to teach you all the lessons that I've learned after taking 13 losses in a row and how I've not lost my head or blown my account. And I think you're going to find the last lesson very helpful, so stick around until the end so you can use that lesson to improve your trading overnight. So I lost 6 trades in a row, then I won 1, and then I lost about 7 in a row after that. And effectively, without that winner, I have lost 13 trades in a row, right? So the same lessons apply. So first and foremost, the first lesson that I learned is that the higher time frames are subordinate to the lower time frames, right? And so this is something I already knew, but it's just something that I really need to hammer home. Like, for example, the 4 hour is way more important than a 1 hour, right? Any key levels you see on the 4 hour should take precedent over anything that you see on the 1 hour. And same goes for the weekly. The weekly, any key levels take precedent over the daily over the 4 hour, the 4 hour over the 1 hour, because that is what price is working off of the most, the higher time frame key levels. So I missed opportunities simply by looking at the lower time frames rather than looking at the higher time frames, which I know I should have been doing, right? And rather than using a high time frame key level, I would use a lower one, and that one wouldn't get tapped into, and I wouldn't take the trade because this trade was not supported by a high time frame key level. However, looking back in hindsight, it had tapped into a high time frame key level that I just hadn't seen or hadn't paid attention to. So lesson number 1 is the lower time frames are always subordinate to the higher time frames, and always keep an eye on your higher time frame key levels and don't depend solely on the lower time frames. Lesson number 2 is wait for high probability, obvious price action in trades. Like, I'm looking through all of these losses, right? I went over and I reviewed them, and I thought to myself, wow, at least 5 of these probably could have been avoided because they just weren't high probability. And it's not to say that they didn't follow my rules. It's not to say that I broke my rules and took these trades. It's just that they could have been better, right? And had I not taken those, that would have been a number of losses I could have avoided. And therefore, obviously, I could have protected my capital and been a better risk manager. So it's not that I took shit trades. They were still good enough for me to think that I could apply risk. But in hindsight, it's like I could wait for even better trades and just be more patient and take the best trades possible and avoid the ones that have anything that suggests that they're low probability, anything at all, right? And that would decrease my trade frequency, but it would probably increase my win rate as well, given that a couple of the trades probably weren't the highest probability. However, the benefits outweighed the negatives. Obviously, that's why I took it, but they had enough reason for me to be like, okay, maybe I could sit this one out. And it's looking back at those and realizing, okay, they could have been better, higher probability trades that had I just avoided taking the ones that were lower probability, I could have saved myself a couple percentage in capital, which means a lot, right, over the long term. So that's point number 2. Wait for obvious price action, right? It should be screaming at you. It should just be like, yo, I want you to fucking take me, right? Because I'll be back testing and I'll not even think about taking the trade until I'm like, yo, this shit looks obvious. And then I'll take it. And then if it wins, it wins. And if it loses, it loses, whatever. But the idea is that it's jumping out at you, right? It makes so much sense. It looks so obvious. And you're almost like flowing with the market. So don't force your perspective on the market. Wait for the high probability trades that are screaming at you, because they're the ones that you want to kind of push your edge in, you know, when they're really, really clean and obvious. And when it's not so obvious and when it's not such clean price action, just sit it out. Like, it doesn't matter. Let the trade pass, let the day pass, and another great opportunity will come eventually. And it will be much higher probability, and you'll be happy that you waited patiently for the one that was screaming at you, right? So number 3 is also don't force entries, right? I think there was 2 opportunities where I was correct in my bias, but because of FOMO, I forced the entry and I got in way too early, and I didn't wait for the proper entry criteria, which is a strong market structure shift and displacement with a fair value gap, right? And there was occasions where I entered prematurely because I just wanted to be in the move, and it ran up and it hit my stop loss, and then it dumped straight to take profit, for example, right? And so looking back at those, there were obvious opportunities to actually enter. And it's not like I ever enter without these, right? So there was a market structure shift and a fair value gap, right? If it was just a pure mechanical approach. but it wasn't good enough. It just wasn't clear enough. It wasn't obvious enough. It didn't have enough displacement, right? And so I need to wait for that displacement. Don't force an early entry, especially when you don't think that is the entry. Wait patiently for that entry, and wait, most importantly, for that displacement, because that is the market tipping its hand to you that you are on the right side of the curve, right? And that smart money is likely in play. And had I waited for those entries, I would have made 2R instead of losing 1R or minus 0.5R, right? So for me personally, and something that maybe you can apply, is obviously just wait for the obvious fucking entry. It should be just obvious. Don't force an entry. Just be like, okay, shit, now's the time to get in. Like, it's just obvious. We've had a clear displacement, clear breaker structure, and a clear entry opportunity. Point number 4 is just chill out on a FOMO, right? I think we mentioned this before, but there's always another opportunity in the market. Like, don't get FOMO, because all these kind of points interlink with each other. Wait for obvious price action and high probability trades links in with don't force entries, right? Because just wait for the higher probability obvious price action. And that comes from having no FOMO, right? So fundamentally, all of these mistakes come from fear, and they come from wanting to get involved, wanting to make money, or not wanting to be missed, right? But like I always talk about, you have to zoom out, look at it from the bigger perspective, and that is how you kind of get rid of FOMO. When you look at it from the larger perspective, it's like, okay, there's going to be infinite opportunities in the future to take a great trade. It does not matter if I get missed on this trade, and it does not matter if I'm right about this trade and I don't get entered, because there will always be a great opportunity in the future to take another great trade, right? So wait for it to be obvious, and don't get FOMO that you'll get missed on the move because an entry won't be presented to you. If it's not presented, there will be another trade down the line, tomorrow, the day after, whenever, next week. There will be another great trade that you will get in on. So don't have FOMO that it's not going to enter you into your position, because it doesn't matter if the market runs without you. There will always be another great opportunity for you to get in on. So that is just, for me personally, it's like, just wait until there's a great entry opportunity. Don't force it because of FOMO, because you see what happens. Price runs up a bit higher, takes your stop, and then you're out of the trade, and then you don't want to get in again because you've just taken a loss on that trade. So just wait until it's obvious and you're getting in at the most optimal point where the market's tipping its hand to you. And that obviously all stems from just getting rid of that FOMO, and that is by zooming out, looking at it from the larger perspective, that there are plenty of opportunities in the future. And point number 5, which is one that I think is actually really, really key that not many people talk about, is using IMA. And IMA is just intermarket analysis. Look at correlated assets and use that to add probability to your trading, right? If Euro and DXY have hit its target, but the pound hasn't hit its target, and Euro and DXY are reversing, what is the likelihood that pound is going to continue to its target when the other two correlated assets are now reversing, right? It's low. So you got to use that, and you got to think using the intermarket analysis. If pound hasn't hit its target, but the other two are now reversing and they're showing a change in order flow, it's now low probability for you to try and short pound. Or say that you're in a trade and once again, Euro and pound hit the take profit, hit their key level that you were aiming for in the trade, but the pound doesn't hit it. What is the probability that we are going to see pound run all the way to the take profit? It's much lower now because all the other correlated assets have hit their take profit points or hit the key level of liquidity that you were targeting. And so it makes sense for you to manage your risk at that point, or close the position or move your stops to break even, because all the correlated assets, they've already hit their targets. And so the likelihood now is we're going to see a consolidation or a reversal. And so start using IMA. Obviously, that includes seeing SMT. Like SMT is something super helpful, obviously using correlated assets to see, okay, which one created a new low and which one didn't. Okay, the one that didn't create a new low is the stronger one. Using IMA more in your trading is going to increase the probabilities, because you can use it when you hit key levels. You can use it for SMT. So start using IMA in your analysis, and that will increase the probability of your trades by quite a lot, or it will allow you to time your entries and exits better so your win rate increases. So as always, guys, if you found anything useful in that, hit the subscribe button, join the Telegram below, and I'll see you in the next video. Peace.